need money to go to an asset that exists outside the traditional financial system. So the whole key here is if you want to be a short-term trader and you try and get around these trends, then you've got to be a financial genius, a lucky and a gambler. If you get those gambles right, then you'll probably come back here when you want to build and protect your wealth longer term because it doesn't sustain itself. If you want to try and do all that crazy stuff that everyone tries to do, then try and get on top of all these different trends and predict them short term and try and buy Bitcoin at the right moment, sell stocks at the right moment, get the tax efficiency right. And then always try to get on the right side of these trends and see things, and also make sure you're an insider so you can see those that are pushing Bitcoin into the exchanges at the same time as doing over-the-counter trades, and the same in the stock market. And you think you can get ahead of all those hedge funds that have high-frequency trading and internet connections directly into the stock markets, and insiders that have the ability to manipulate crypto exchanges in the short term. If you want to get on the right, if you want to try and beat all those people, then feel free to continue trading. If, however, you just want to calm down, get on with your life, do what you need to do, and if you do that as a hobby, fine, take a percentage of it and do that as a hobby. But in the investing side, you've got to look at the long-term trends, and what I like is asymmetric bets. And an asymmetric bet is an above normal return with a lower amount of risk. And that's why Bitcoin benefiting from quantitative easing, quantitative tightening, increases in interest rates, decreases in interest rates, inflation, bank failures, is, in my perspective, a responsible thing for people to hold a percentage of their wealth in because of those long-term trends. And don't let the short term and medium, make you do things that I've seen over the last 13 years in the highest performing asset class in history. People end up with less Bitcoin than when they started. So the way to think about this is to make a few psychological shifts. So firstly, if you want to be the short-term trader, there's great literature on trading psychology. Don't try and get it right. Understand that mechanism on what drives markets, fear, greed, and then you have to get money management and psychology right. But in the long term, the way to think about this is driving yourself away from fiat thinking into Bitcoin thinking. I've covered this in many videos in the past. Fiat thinking is where you combine your spending account with your investment account, and as your assets decrease and increase in value, the psychology plays upon you, driving you to do stupid things because you're analyzing it in terms of paying your rent, paying your mortgage, and that is because you haven't separated what fiat does really well, which is stably in countries that don't suffer from hyperinflation, short term allow you to meet your expenses. But combining that with your savings is where everything goes suicidal and people get things wrong. And then they end up investing and saying, I can't afford my rent this month, so I've got to sell my Bitcoin, and get on the wrong side of short-term trends. So firstly, you've got to adjust yourself to Bitcoin thinking over fiat thinking, which means that when you have it separated, the lower the price of Bitcoin, the more you get to accumulate, the better. As it goes up, you feel good in fiat terms. And so that's the way to get on the right side of that. The other thing that you can do to adjust is, rather than valuing everything in dollars, value everything in gold. Gold has been a wealth preserver and not wealth creator, a wealth preserver for 5,000 years. So if you take the price of stocks denominated in gold, and if you take the price of dollars denominated in gold, and if you take the price of Bitcoin denominated in gold, you get to see a fairer picture that allows you to understand the longer term trends here. If you want to get a bit geeky, do it as a logarithmic chart so it takes out all the noise. Essentially, that just changes the axes. Don't want to get too geeky, but by pricing things in gold, it forces you to shift your thinking. By thinking in terms of Bitcoin accumulation rather than fiat accumulation, it drives you away from the short term and makes you think on the long term. And by understanding the differences between the long-term demand and the short-term is the key to really building and protecting your firm. So the answer to the original